The year is folding into winter. For income hunters, December is a line in the snow. Ex-dividend dates, one last window to collect payouts before the calendar turns. Some buy for yield, smarter ones buy for durability. Tonight, 5 names stand at the crossroads of yield and history, each with a story worth the price of admission. Give me safety. Give me yield. Give me a reason to sleep. Then let us start with pipelines. Enbridge, ENB, the great conveyor. Enbridge moves what powers a continent. Pipelines are not glamorous, but they pay predictably. This giant has stitched decades of cash flows into a dividend that has been raised many times over its long history. For zero, Enbridge's quarterly payout translated to an annualized amount that investors watch closely. Its model of fee-based, inflation-linked contracts gives it a foundation for durable income. That predictability is why many dividend investors treat Enbridge as a core dividend holding. Look at payout cadence and contract structure, not the spot price of oil. Pipelines earn fees whether commodities spike or slump. If you want a high single-digit-ish yield with long-term raises and a business that's hard to replicate, Enbridge is the archetype. Remember, pipeline payouts reflect decades of infrastructure investment. They are slow-moving but stubbornly dependable. BCE Incorporated, BCE, the phone in your hand. Telecommunication is the economy's nervous system. BCE, the bell, collects monthly fees from millions. That delivers cash. BCE's quarterly dividend per share has been a steady drumbeat, paid on dates Eskin calendar. Ex-dividend dates in September and December are especially relevant for the cautious buyer chasing the season's payout. For S who prize steady yields from a national telecom monopoly, BCE remains a staple. But is the payout secure? Telecoms carry heavy capital needs, yes, but BCE's long record of payouts and scheduled quarterly distributions make it one of Canada's classic income names. If you want exposure to essential services and an attractive payout before December, note the declared quarterly amount and the ex-dividend calendar. Telecoms survived industry restructuring, regulatory transitions, and the shift from voice to data. Those who rode the change kept the dividend flag flying. Royal Bank of Canada, RY, the Vault. The Big Five banks of Canada are a story stitched into the nation: conservative lending, diversified operations, and a bias toward returning cash to shareholders. Royal Bank of Canada, the largest of them, has consistently scheduled and paid quarterly dividends and historically leaned on its retail and capital markets engines to support distributions. For those seeking both defensive balance sheet strength and reliable income, RBC is a natural pick before year-end. Expect lower nominal yields than some energy or pipeline names, but a higher sense of stability. Banks' dividends reflect both earnings and regulatory oversight. That's a feature, not a bug, for conservative income portfolios. After 2008, Canadian banks tightened capital practices. The lesson was simple: resilience matters. Dividends from well-capitalized banks can be the anchor of a winter portfolio. Fortis, FTS, the steward of power. Utilities are the archetypal dividend sector, regulated, cash predictable, and politically sensitive. Fortis, with a history of steady increases and a low volatility profile, has long been a go-to for conservative yield. Its dividend yield lives in the mid-single digits territory when markets fluctuate, and its payout history shows modest but steady growth. Precisely the soup for someone who want their evening news about electricity, not earning surprises. So less drama, more moderation. Yes. Fortis offers lower beta and a dependable payout that tends to march upward over time. For December buyers, it's about locking in a yield from a regulated business that people pay for come rain or shine. Utility dividends are a tax on comfort. We pay for light heat connection, and cash dividends follow. Pembina Pipeline, PPL, the shortcut to Midstream. Yield. Pembina sits in that intersection between energy, utility, and infrastructure, a midstream operator that benefits from North American hydrocarbons demand and fee-based contracts. Its distribution profile often offers higher yields than pure utilities and, at times, a more attractive entry point than the largest pipeline names. S who want infrastructure exposure, but also crave a higher headline yield, give Pembina a look. Recent company disclosures lay out dividend series and reset terms that matter to income planners eyeing December. Beware the operational and commodity cycle sensitivity. Pembina's payout is supported by long-term contracts, but is not immune to sector downturns. Position size and diversification matter. Pipelines and midstream firms have been through boom and bust. Those who remain profitable are often those who adapted contract terms and disciplined capital allocation. If you're buying before December, remember three practical commandments. Check ex-dividend dates. If you want this year's payment, buy before the X date. Otherwise, you wait for the next quarter. BCE's X dates, for instance, are scheduled around mid-September and mid-December. Don't chase only the highest yield. A sky-high yield can be the echo of a falling share price or payout risk. Balance yield with coverage and cash flow quality. Diversify across sectors. Pipelines, utilities, banks, and telecom each bring different cyclicality. Together, they smooth the ride. So, a little of each: pipeline for yield, bank for stability, utility for steadiness, telecom for cash flow. Precisely. And size your positions to match risk tolerance. Remember the lessons. In the late 20th century, utilities and pipelines grew as the economy industrialized. The banks consolidated to survive crises. Telecoms shifted from voice to data and emerged as gatekeepers. Each sector's dividend story is a product of structural demand. Homes need power, commerce needs pipes, families need connectivity, and economies need credit. When markets panic, the companies that serve essential functions show why dividends can be less ephemeral than headlines. And yet, past performance is a story, not a guarantee. Use history to inform judgment, not to replace it. Here are the 5 names I mentioned in this video. Not an endorsement, but a starting line for due diligence. Enbridge, ENB, infrastructure, fee-based contracts, long dividend history. BCE incorporated BCE, telecom cash flows, and scheduled quarterly payouts with key X dates in September and December. Royal Bank of Canada, RY, the defensive bank with steady divisional cash and a long record of shareholder returns. Fortis, FTS, regulated utility, low volatility, steady dividend growth. Pembina Pipeline, PPL, midstream yield play with infrastructure contracts and reset style preferreds worth watching. Before December arrives, you can confirm ex-dividend dates, review payout coverage ratios, and size positions with stress scenarios in mind. I want income, I want safety, I want a story I can hold, then buy with both numbers and narrative. Dividends are a promise, yes, but also a conversation between business and owner. Know who you are before you buy what speaks to you. The curtain falls on the certainty and rises on risk. These 5 names offer different flavors of income for us racing the December calendar. Use the facts, the yields, the X dates, the contract terms, and temper them with prudence, diversification, position sizing, and an eye to macro shocks. This season's dividend is only as good as the company behind it.